Hello. Welcome back, friends, to Alpha Beta Soup, where we unpack Bitcoin using on-chain analysis. I'm TXMC. Well, I've been away for a couple of weeks, and we have quite a bit to talk about. We'll look at the Bitcoin price chart, we'll check out the indices, and then we'll look at Bitcoin on-chain, at the futures market, at the options market, and try to get a sense of what we think this asset is doing. You're tuned in to the best Bitcoin and on-chain analysis channel on YouTube, and your support means everything. If you enjoy this content, make sure to give my video a thumbs up and subscribe to the channel. I couldn't do this without your support. It's been long enough. I won't keep you waiting anymore. Let's get into it. Well, here we are. There's not much to say about this price chart, now sitting just under 40K. And the last time I made a published video, price was somewhere in this candle right here, rallying out of the recent lows in the mid to low 30s. And with everything going on in the macro picture, with the continuous selling off in US equities, my expectation for the rally was very low. And as we've seen now, steam has run out and we're working our way back to the downside. If we come over here to my chart of horizontal levels, the 3-day close yesterday closed below my structural support line, which sits here at 40,700. And on my 3-day chart, this has been an important structural level throughout this entire range since the beginning of last year. And my thought was that if this particular rally had any strength to it, if there were actual legs behind it, then there would be no reason for us to have another 3-day close below this level. Yet here we are right back in the same spot. So for now, my expectation is we continue to bleed down into the low 30s. That has remained the highest probability outcome for the last several weeks. But I was leaving a possibility open in my mind that this rally could be the relief rally that we've all been expecting to happen based on the way price normally behaves. But as it stands right now, I don't think that that's what we're going to get. And I instead think we are in for maybe a few weeks of price action down here. Maybe it pops its head back up a couple of times. But because we're seeing this weakness, because of some other things we'll talk about here in a moment, it just feels like we're in a period of complete risk off, total lack of appetite for speculation. And I believe this environment could persist well into March. Now we do have this fractal right here that price has been following in a very eerie fashion ever since the rally began in October. Now this price fractal here, some of you may have seen it being shared by other analysts, Blockchain Backer is one, and this fractal here belongs to this moment on the price chart, which came in 2018 in the bear market after the 2017 peak. This fractal right here. And we are currently in this phase of it. Now the eerie thing about this fractal is, we see price fractals play out all the time. Sometimes they play out very close to past history. Sometimes they just have a similar structure. And the really interesting thing to me about this fractal is just how closely we have been following it ever since it began in October. I mean, every major down move on this fractal has occurred within a day or two of the original down move on the first fractal. It even made a high and then a slightly higher high before rolling over. This is eerily similar, and it's very unusual for a price fractal to follow a past moment this closely. But here we are, even the drawdown from yesterday. So I don't know how long that we will continue to follow this. There's no way to really know, but until it starts to show a significant deviation, we can use it as part of our base expectation because it has followed it for now several months. And what it's showing right now is a little bit more downside, down into the mid 30s, before maybe we reverse and get the relief rally that people have been expecting. But I won't get too attached to this particular outcome here because we'll know more as this begins to play out. If this price fractal is still following things this closely by the time we get up here, I think it would be reasonable to expect the relief rally to run out of steam in the high 50s. But we're still weeks away from this potential outcome. But one thing I think it's important to keep in mind is how closely Bitcoin has been tied to the stock market. So to me, it's not reasonable to expect Bitcoin to begin behaving anomalously by itself when the rest of the markets are still in a general downtrend. Here is the percentage change of Bitcoin and the three major indices since the beginning of 2022. And you can see Bitcoin is right on par with the NASDAQ and just slightly below the S&P and the Dow. But they're all pretty much following each other. It's just that Bitcoin is following it with a higher beta, with more volatility. And when you look out across the indexes, when you look at Bitcoin and the S&P and the Dow and the NASDAQ, all of them are well below their 200-day moving averages, which is these red lines on each of these boxes. The S&P, well below it. The NASDAQ, far below it. The Dow, below it. And we talked about on this channel that if the indices broke below their 200-day moving averages and spent any time down there at all, it would lead to significant de-risking across the board and likely an extended period of chop and maybe more downside. Well, that is what we have been getting, friends, across every index, and it could take a few more weeks to dig out of this situation because there are some important events coming up in March. First of all, on March 10th is the next CPI report when we find out what the new inflation print is. And then on March 15th and 16th is the next Federal Reserve Committee meeting. That is when we are likely to hear about the first of a series of rate hikes. And I think that until we get to that moment in mid-March, what we've been seeing out of the markets, out of Bitcoin, all of that is likely to continue. That is my base case as of right now. I would love to get a pleasant surprise to the upside, but the macro picture is so hairy right now with what's going on in Russia and Ukraine, with what's going on in Canada with the trucking protest and the crackdowns up there, and then the continued de-risking across all equities. The climate is simply not one with an appetite for risk, so we have to keep that in mind. I mean, what if I just go and look at some of the biggest stocks in the world? All of them look like absolute trash. Look, here's PayPal, all the way down at 2020 levels. Spotify at a similar point at March, April 2020 levels. Alibaba, oh my gosh, Alibaba getting absolutely destroyed all the way back at 2017 prices. Netflix, absolutely gutted all the way back to April and May 2020 prices. Facebook getting utterly demolished, also back down to April, May 2020 prices. These are some of the biggest companies in the world, some of the most well-known brand names. And for them to get absolutely smashed like this, straight down, and so far, absolutely no hint of a bounce on any of these tickers. For that to have happened to some of the largest companies on earth means that the liquidity in the market is at a very low point. There's almost no demand there waiting to catch the falling knife. And when you see that kind of climate, and then we see all of the indices below their 200-day moving averages, I'm telling you, friends, this is just not the place to be taking risky bets. This is an environment to fold your hands and observe and wait for the market to clear itself up, because right now it has priced in so much uncertainty that there is no direction whatsoever, and we need some of that uncertainty to clear up. That's why I feel that mid-March is a good target period to expect some of this to begin to unravel and become more clear. I want to pivot a bit here to the derivative space for Bitcoin. Here we're looking at our futures dashboard that we've spent much time on. And when we look over here at futures open interest, which is the raw sum total of open contracts in all of Bitcoin futures, the value has been pretty elevated, near its relative all-time highs. But since early January, we've seen a steady unwinding of open interest. I'm going to switch over here to one of my own charts for open interest. So down here, what we're looking at is the same exact chart we were just showing before. This is futures open interest. Now the black line going across the middle here represents 2% of supply. And whenever futures open interest gets near or above 2% of Bitcoin's supply, or of Bitcoin's market cap, depending on the denomination you're using, when it reaches that point, typically that is a maximum cabin pressure moment, and often we see a very quick unwinding, cascading closures in futures. And you can see some of those moments on this chart down here. These orange and blue lines represent single days where open interest changed dramatically. And the orange bars are days where open interest fell by a significant percentage. And if you look at where those moments are in relation to this black line, almost all of them, with the exception of 1 or 2 moments, came when open interest was at or above this black line, this 2% of supply mark, which is why we say it's a maximum cabin pressure kind of level. For whatever reason, that tends to be about the most amount of leverage and speculation that futures is able to sustain. Now, if you drag your eyes over to the right side of the screen here, this is the beginning of the year, right? This is the early January, late December period. And what we've seen is open interest slowly unwinding out of this area. You see that? Just slowly unwinding rather than seeing a big liquidation. We haven't seen one of these colored prints since December 4th. However, open interest has been slowly unwinding into this drawdown. We're not seeing it rise. We're not seeing a sudden influx of new contracts, just the steady closing out of positions and the withdrawing of capital. That is a de-risking behavior, friends, and it's in line with the assessment we just made on the price charts of steady de-risking and a lack of appetite for speculation. So we're seeing that steady unwinding of open interest. So we mentioned the steady unwinding of open interest, and it also is in line with the steady decline of futures volume. So this is the actual traded volume day to day, the contracts that are changing hands and those that are closing, shown here in volume with a 7-day moving average. And this value has been in a structural decline since maybe August, September. Another interesting chart to look at is here the futures term structure. And if you look out towards the end of March, they're trading essentially flat. And if you look at the premium out to the end of December, it's only like 5%. So it's pretty clear that the futures market is not anticipating any large bullish impulses. And the flatness of the term structure through the end of March really reinforces how the market is waiting for the Fed. They're waiting for the next FOMC meeting on March 15th and 16th, like we talked about. And I think that it's really highly likely that the market continues to chop around in its existing range for the next few weeks. We can see a bit more of this hedging and lack of risk if we look at the put-call ratios in options. So this is showing you the amount of people buying puts versus the amount of people buying calls. And when people buy puts in options, they're providing themselves downside insurance. When you buy a put option, you are buying the right to sell a stock at a lower price in the future. It's a way of protecting yourself from downside. So if you were expecting, or if you thought it was possible that price was going to see additional downside from where it is now, you would buy a put option at a price you're willing to sell at. And it provides you a backstop to protect you from downside beyond that point. What we've been seeing is an increase in the amount of puts being bought in options. You see how this line is increasing? This is the open interest put call ratio. This down here is the volume put call ratio. So these are the traded and settled contracts. Open interest are the ones that are left open. Both have been rising since late December. More puts than calls. So the options market and the futures market are both demonstrating a hedging, a risk-off behavior, and anticipation of chop through at least the next month. And when we see the smart money, the sophisticated traders demonstrating these behaviors, it's important for us to make sure we are aligning with the smart money. Here's a look at active entities. So we talked about the price chart. We talked about the derivative space and how the market is demonstrating a risk-off hedging behavior. That sentiment is pretty clear, and I think it will persist at least for the next few weeks until we get through next month. But there are some positive developments, and one of those is the steady rise of active entities. So when I look at active entities, now these are active participants on chain, unique individuals transacting in Bitcoin each day. When I look at active entities, we have a couple of different dynamics for this chart. One of those is there's a steady baseline growth channel that occurs in bear markets. Year over year baseline adoption and activity on the network each day. Participants showing up to transact in Bitcoin. That value is on a steadily rising floor. Now, whenever we get into bull markets, those periods show elevated active entities and the value breaks out above its typical channel. You can see that back here in 2017. There was a brief period of that in the 2019 mid-cycle rally and then a huge burst in late 2020 and early 2021. Now, we did get a bit of elevated entities as we were rallying through September and October, but it has since fallen back down. And interestingly, it is in this bear market channel where it has been all along. We also saw a bit of elevated entity activity as we were rallying into October, and then the value receded back down into this channel. But it is rising, and it's a higher level than it was at in June, July, and August. So while we still have a risk-off behavior in the market side, and while derivatives is not showing any kind of clear bias, they are also very hesitant. The year-over-year adoption curve for Bitcoin continues to march forward, which really helps to emphasize that these periods that we go through where price is very ugly, where there's a lot of de-risking, where capital is being taken off the table, those things occur cyclically. And when you zoom out from those periods, when we look back at this moment in time, a year from now or 3 years from now, what will be more important is not whether the price made its way back down to 30K before bouncing up to 50. None of those things will matter. But what will matter is baseline year-over-year growth in adoption, in users, in transactions, in volumes. Those kinds of things are what will determine the long-term success of Bitcoin. And that machine of adoption is still marching on. So there are positive developments occurring for Bitcoin underneath a lot of this uncertainty. Another interesting dynamic I want to show you guys is how the flow of exchanges is different here. So one of the things that we look for when the market is showing weakness, when we feel like it's going to roll over into a bear, we look for an impulse of deposits to exchanges by people looking to exit the market. That kind of behavior demonstrates a willingness to spend your coins. And when we look back at the drawdown in May of 2020, we had a huge impulse of exchange deposits. This chart here is showing exchange net flow, so the volume in and out of exchanges on a 90-day sum basis. The colors themselves represent the 90-day change of price, not of exchange flows. So what I'm showing you is volume in and out of exchanges, colored by what's been going on with price in the 3 months leading up to that point. Now, if you look here during the bull run, we had steady outflows, month on month, coins being withdrawn from exchanges as price was rallying. The color is green because price is green over 90 days, but the volume for the exchanges is negative, so it's printing down below the baseline. But then when we get to May of 2021, when we start to see the drawdown, we started to see deposits onto exchanges happening while price was drawing down. So red color, positive values on exchange net flow. This is the panic exit of investors. Get me the hell out of here. Depositing my Bitcoin onto the exchange, selling it to someone else. That's this behavior right here. But look at this drawdown. Look at the drawdown from November to now. Another 50% drawdown, similar in size and duration to the drawdown from April to the end of July. However, the behavior of exchange flows is vastly different. Note the aggressive depositing week on week for several months of coins to exchanges during the June to July drawdown. Then look over here. Look at how minimal the inflows to exchanges have been during this period, despite the fact that we've seen a similar type of bleed down. Now, it's not as dramatic as this fall was here in mid-May, but percentage-wise, we've covered a similar amount of ground. However, the sentiment of holders is not to panic and flee for the exits. Much Bitcoin remains off of exchanges. And in fact, if I were to show you exchange balances, they are at Q4 2018 levels. So they are at multi-year lows on total exchange balance right now because we have seen continual outflows throughout 2021 and during this drawdown, minimal inflows. So this is almost like a tale of two corrections happening here for Bitcoin. And it's an interesting dynamic that I think helps to tell part of the story of what's going on for this asset right now. And what Bitcoin's kind of been doing for the last couple of months is following equities. Now, if equities themselves plummet into some disastrous bear market, Bitcoin is going to go with it, at least at first. But for the Bitcoin market by itself, irrespective of whatever's going on in the macro landscape, the holders of BTC had their capitulative moment. They had their, oh shit, this is going to crash moment, and it was back here in May of 2021. That is where we really saw the air come out of the balloon. And the behavior demonstrated on chain in this period of time is not exactly the same as the behaviors we've seen in the last 3 or 4 months. Here's a look at our spent volume age bands. So we identified de-risking behavior in derivatives, in futures, and in options both. We also identified that exchange deposits have been relatively mild during this recent drawdown compared to where they were 9 months ago. And also, interestingly, the spending volume coming out of coins from 6 months or longer ago is also in a continual structural downtrend. So there was a spike recently, this spot right here on my mouse cursor, and this is actually from coins related to the Bitfinex hack from 2016 being moved on a particular day. It happened at the beginning of February, and then a week later, we found out that the United States government had seized a bunch of the coins. So if we ignore this one little blip right here of spending, this is in a structural downtrend from the all-time high, which shows that coins 6 months or older are not being spent, not in any notable percentage. It's down at 1% of daily volume, likely lower than that if we didn't get this recent burst up that kind of dragged up my 30-day moving average. So the spending volume of holders is not very high at all, which goes hand in hand with the general assessment that liquidity is low across the market. It seems that hodlers and speculators alike are all sitting on their hands and observing. And I feel like that's probably the smartest thing to do right now for most people. This is a very difficult market to actively be making decisions in. There are a lot of moving parts, both geopolitically and economically. And finding an edge amidst all of this noise is a monumental task. There are times when I'm able to assess the market and present a cogent and clear narrative for what I believe is going on, for the direction that I think we may be headed in. Right now, the assessment that I can pull is that we are in no man's land. We are in Chopville. When I see a complete lack of spending out of the people who have the majority of coins, when I see deposits to exchanges kind of ho-hum and not really much to write home about, despite the fact that we've drawn down 50%, when we see this steady unwinding of open interest in the futures market without any major liquidations, just kind of steadily creeping back down to manageable levels. We see futures showing almost no bullish expectation at all out through the end of March, and even through the end of the year is rather conservative. We've also noted an increased volume of downside insurance being acquired by traders in the options market, buying more puts to protect themselves from downside. All of those things are occurring while each of the major indexes are well below their 200-day moving averages, and Bitcoin itself has now closed below what I feel is a key structural support level just above 40,000. Friends, the market is telling you a story, whether you want to hear it or not. And that story is take your hands off the controls and wait. Make yourself a cup of coffee and simply observe. The next few weeks are likely to be more of this. We may get another capitulation. Maybe we come down and we test this wick. If we do, I would expect there might even be a sharp move down below that to 30K, because getting down here would be scary. This day was terrifying for people. With the current conditions of the market, with the amount of fear that's out there, the amount of risk-off activity going on, the market is already scared. And price has a way of gravitating towards the most painful spot for the most amount of investors. And when I think about what that looks like, to me, it's a visit down here to Goblin Town. So that's kind of what I'm looking at right now. Price weakness, structural weakness, indices showing weakness, and an aggregate risk-off attitude across all of derivatives for Bitcoin. Make sure you're following me here on Twitter at TXMC Trades. I post a lot of my charts and analysis here, and I also like to go in Twitter spaces and talk with folks. So if you're following me here, you'll find out when I jump in those as well. The market is telling us a clear story, friends, whether we are wanting to hear it or not. Between what's going on with Russia and Ukraine, with what's going on in Canada with the trucker protests, with people wondering what Biden's executive order is going to look like for cryptocurrencies, with inflation running historically high levels, and next month's Fed meeting expected to begin a new series of rate hikes, the entire market is showing a complete lack of appetite for risk. And it's important to take what the market gives you. So we will continue to observe what is happening on the global stage. We'll keep an eye on Bitcoin on chain. And when we believe there is signal rising up out of the noise, we will discuss it at length and unpack it. In the meantime, it's important to stay defensive, to protect yourself from overexposure, and to wait for the market to sort itself out. We go through these phases cyclically, and if you learn to ride the wave, it can make your time in the markets more manageable. And right now, there is no wave to ride, so we wait for momentum. We'll give the market a couple of days, and then we'll make another video. Maybe at the end of the week, we'll do a live stream. I haven't decided yet, but I'll make sure to announce it in plenty of time for you guys to join. If you have any questions or feedback for me, make sure you leave it in the comments down below and I'll check them out. But that's it. I've been talking for a while. I want to let you guys go. It's my first video back in a couple of weeks and I don't want it to go too long. I hope you're having a great weekend. Take care of yourselves, friends. Find some time to relax and we'll chat again soon. Cheers.